Let's talk to Mike Ingram. He is the Chief Market Strategist for WH Ireland, making his debut here at Core London. Mike, Happy New Year to you and your family.
Morning, mate.
Right, let's kick off. Lots of grim outlooks for 2018. I've seen so many lists of what could go wrong. What interests me, what could go right in 2018?
Well, there certainly seems to be a decent amount of economic momentum at the moment. I mean, if you look at the sort of broad macroeconomic outlook, we had a very major growth surprise during the course of 2017. We thought we were going to get a repeat of 2016, which is the worst growth we've seen since the great financial crisis. In fact, we saw the best growth that year since 2011. It's expected to actually accelerate a little bit during the course of this year. It'll be a different mix. I mean, the US is going to perhaps pull a little bit more weight. Of course, the tax Trump so-called reform is going to be at least part of that. We've seen better numbers out of China, and there generally seems to be a bit better momentum out of emerging markets. And although we're expecting a bit of a slowdown in Japan and also the Eurozone, still quite decent numbers that they're going to put in. So it seems like the global economy is firing on all engines at the moment. Growth maybe 3.7%, which is pretty decent. Yeah. And the flip side of this, and this is why people are talking about the so-called Goldilocks economy, is that even though you're having this pickup in growth, you're not really seeing much in the way of inflation. If you took inflation on a global basis, it's pretty much going to flatline during the course of 2018. It's certainly not going to pick up significantly from where we left off last year. So, that's probably one of the reasons why the central banks are only tentatively edging towards easing. We know that the ECB has tapered in January this year. They may well stop QE entirely before the end of this year. We know that the Fed is shrinking its balance sheet, but it's all quite tentative at the moment, and the market, frankly, is not quite believing still the Fed dot plot, for instance. Yeah. So, as I say, this environment of high growth, low inflation, low rates is actually still quite conducive for performance of risk assets. And thus far this year, we've seen, something of a melt-up, I'd have to say.
OK, so let's talk sectors. We saw GKN being approached by Melrose on Friday. What sectors do you think will be in vogue this year?
Well, one would have thought that, given the macro environment, you're still going to see banks do relatively well. Of course, they tend to some extent be macroeconomic proxies. I think the caveat there, perhaps, and this probably applies to some of the more cyclical sectors anyway, is do we see this sort of steepening of the yield curve again? One thing which didn't happen last year, people say, well, long rates are going to start to edge up. Didn't really happen to any significant degree. Towards the end it perhaps did. That could upset the apple cart to some extent. But I think, if you look at, say, the Eurozone, for instance, consumers feeling pretty perky. You're not seeing much in the way of real wage growth, as indeed you're not in the UK, but you are seeing very significant gains in employment. The unemployment rate is actually coming down quite aggressively, which means that there are physically more consumers out there to go out and buy stuff. Against that, consumer staples perhaps not quite so interesting again, particularly if you think that some of the bond markets are looking very overpriced at this particular juncture. Okay, so what's the biggest danger, the biggest fear for you? Is it inflation this year? Yeah, I think it's quite interesting because we got some inflation data out from the US on Friday. And the market price action was quite interesting because you saw a core inflation number for December, which exceeded expectations. And initially, you saw quite a bit of a sell-off in the bond market, as you'd expect. And there were knock-on effects in global equity. And for instance, it drove the FTSE 100 for a while into negative territory. Again, the market eventually, after an hour or two, just shrugged it off and continued going on higher. So that, you get feeling there's a sort of an air of complacency out there. Something related to this is actually a weak dollar. Now, going into, again, 2017, you'll remember this, everybody was going, well, it's only a matter of time until it's parity with the euro. And of course, at precisely the moment that everybody said that,
rang the bell,
you might as well have gone long euro, particularly after the French presidential election concluded in May, didn't it, last year? It was a one-way street really for the euro. So the consensus this year is that the dollar is going to get weaker still. Now, thus far, the dollar hasn't really reacted to these so-called increasing interest rate differentials, i.e. US rates going up albeit gradually, also quantitative tightening from the Fed, ECB on hold, certainly on interest rates, on hold probably for the next 2 years. So, the market hasn't reacted to that. The dollar hasn't reacted to that. And, the dollar was down 10% last year. So if we even see half of that retracing, that's going to mix it up a bit. So for instance, one of the star performers in asset markets last year were emerging markets. Now, the emerging markets have tended to struggle in a strong dollar environment. It was a massive tailwind for them last year. Is it going to be a headwind for this year? That's not consensus. But, as I mentioned, we can see how quickly consensus can get turned over.
Yeah. And finally, politics this year make you nervous?
UK politics certainly do. I mean, again, the market has been largely desensitised to risk overall, and politics is an element of risk. Again, they've tended to shrug off. I mean, if you look at one of the things which did go wrong last year, was say German politics, yeah. So we had an inconclusive German election. Merkel is still struggling to build a coalition. I think eventually we will have some form of grand coalition, but the market decided just didn't care. And what with Trump and so forth, I think the market's become largely desensitized to political risk. But in terms of something closer to home, I've got to admit I am quite surprised with how the market has turned a blind eye to what's going on in the ongoing Brexit negotiations, because we only moved on to phase two, the so-called sort of trade discussions, by agreeing we're going to deliver something, for instance, on the Irish border. So we seem to agree that there'll be no border between Northern Ireland and the rest of Ireland, but also no border in the Irish Sea. Now that to me implies only one of two things: either you're going for a Norwegian type solution, or you're going for no Brexit at all, neither of which I think is politically palatable in this. But we've kind of kicked that into touch, so we're kind of ignoring it. Market sticking its fingers in the air, going la 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 la, and everybody goes on by sterling. So but at some point in time, this is going to come back to haunt us. I presume it's not going to be in the second half of this year. But again, there's a certain amount of complacency out there. And again, if you looked at how the market reacted during the course of 2017, you'd have to say those more domestically orientated companies, with more exposure to the UK economy, pretty much performed on a par with the exporters, which is quite strange, really, given the exporters are doing well. And we've been reminded time after time after time, sort of Debenhams, Marks, Tesco's, that the UK consumer is really struggling.
Mike, we've run out of time. Happy New Year.
You too.